So we're delighted to welcome our speaker today, Ewan Sinclair, who has a tremendous background as an author, 3 books at least, to his credit, and PhD in theoretical physics from the University of Bristol. I first saw Ewan take part in some online activities at Elite Trader, where he was and is a contributor occasionally. And so I knew right away that he had a strong, generous quality to his and experience too in talking to people at different levels, which I'm sure he got a lot of at Elite Trader and in other scenarios as well. So we'll just give, I think we'll have the presentation by Ewan and however he wants to approach it. And then I'm looking forward to some questions. And what we'll do, well, let's save that until we come to it. So Ewan, just take it and go however you would like.
Well, thanks for that introduction. I just want to make it very clear that this has nothing to do with me being generous. It's just a nice way for me to hear my own opinions regurgitated by me, which never gets old. So first I want to start with a disclaimer. Currently I'm working at Hull Tactical Asset Allocation. And because we do accept outside money, I have to put this in. So it's the standard sort of thing. All the opinions here are mine. They've got nothing to do with Hull. We're not making any solicitation or recommendations. And also, obviously, trading is inherently risky. You can lose money, and past performance, no indication of future success. So that's in there for legal reasons. It should also be in there for, if you don't get this, you shouldn't be in this presentation reasons. Because these things, if you don't understand that trading is inherently risky, if you don't understand that it may lead to losses, you probably aren't cut out for this either financially or psychologically. Trading is all about nuance. So nothing that I say should be taken as absolute. So everything should have an implied generally or usually. So when I say something like, I don't know, options are overpriced, that doesn't mean options are always overpriced. It doesn't mean all options are overpriced. It just means in general, most options are overpriced. Okay, so having said that, let's move on to the interesting parts. I assume you want to know this. In order to be a successful trader, you need a strategy with positive expected value, you need good risk control, and you need the psychological makeup to stick to the first of those 2 bits. Expected value is by far the most important. If you don't have a good strategy, it doesn't make any difference how good your risk control is or how good any intangible psychological qualities you think you have are. You are not going to become a good trader because you work hard. You're not going to be a good trader because you're dedicated. You're not going to be a good trader because you're disciplined. There are a lot of people who are disciplined and dedicated and work hard, but if they're doing something intrinsically stupid, they're still going to lose money. You can go and play the lottery in a very disciplined manner, and you're still not going to make any money. So risk control and psychology are important given you have a strategy with positive expected value. And a lot of people get that the wrong way around. They will say risk control is the most important thing. I mean, it really isn't. I mean, I don't know how to make that, I don't know how to emphasize this any more clearly. If you're not doing something where the odds are on your side, nothing else matters. It's like having good risk control and a bad strategy is like being a tough boxer. If you're a tough boxer, but you're not a good boxer, it just means you're going to get beaten up longer. You're better off if you're not good to be not a tough boxer, and then you'll get punched once and you'll fall over and you're out of the game. It's the same with being disciplined. If you're doing a losing strategy in a disciplined manner, it's going to be worse for you. You're going to stick around and you're just going to lose money in a much more consistent manner. Similarly, this sounds bad. Optimism is about the worst thing a trader can have. If you think that things will turn around, that isn't in any way help for you. The only way things will turn around is if you make them turn around. So, oh, and by the way, I do say psychological makeup is important. It is, and a lot of people have trouble with it, but you're much more likely to have psychological problems like frustration and anger if you're losing money. It's almost certainly a result of losing money rather than a cause of losing money. And if after all this, you're convinced, and maybe you are, I don't know, you're convinced that what's holding you back, your real weak link is the psychological part, deal with it like you would if you had any other real problem. If you have a problem and you know your strategy isn't any good, then you'll work on your strategy and you'll realize it's going to take you time and effort to improve it. You've got to do the same thing with psychology. You can't just look at a YouTube video or read a self-help book. You really need to address it. You probably should get professional help. Cognitive behavioral therapy would really help in that regard. A lot of people claim they have a psychological problem and then just don't do anything about it. I mean, to be fair, a lot of people, complain about stuff and do nothing about it in general anyway. But anyway, this is what you need, and that's the order in which you need it. So coming back to expected value, which the earliest known reference we have to it was a French reference, and they referred to it as mathematical hope, which I quite like as well because it has sort of seems more apt for a trader. Okay, so mathematically expected value means the weighted average of all your outcomes is greater than 0. So the canonical example is you've got a biased coin, comes up heads 55% of the time. So if you win $1 when you win, you lose $1 when you lose. The expected value for that would be 0.55 times 1 minus 0.45 times 1, or 10 cents. So over time, if you flip that coin enough times, you will win 10 cents per flip. Obviously, the result of any given flip cannot be 10 cents. But on average, that's what it means. It means on average. Now, how do you find that? Well, the thing that's not going to help is any knowledge that you think you have. Reading the Wall Street Journal or reading The Economist and then deciding to do a trade based on that is not going to help you. The hard bit about finding expected value isn't so much being right. It's being right and different from the market consensus. I mean, it's very obvious to everyone that electric cars are going to be the future. That in no way relates to thinking that buying Tesla stock's a good idea. You have to ask yourself, is knowing what we know, knowing what everyone knows about the future, is Tesla stock underpriced given all that? And you being able to back out based on your reasoning a valid answer to that is very unlikely. And now that's if you're an expert. There are some people, I have a friend who is on the board of a major pharmaceutical company, and she knows practically everything there is to know about the development pipeline of new drugs. And so she plays around a little bit with biotech stocks. She hasn't done notably well. And so even if an expert in a subject can't find edge this way, it's very unlikely you can. Now, even worse than that is if you've somehow convinced yourself you're an expert in something that you don't know anything about. The classic example of this is the Fed. Every trader has opinions on what the Federal Reserve is doing. This is, well, for an outsider, it would be very odd indeed. Now imagine if you're an engineer and you've been studying engineering at college for, I don't know, 5 years. You've got 20 years of experience. You do it literally every day. Now imagine if I've been watching a series of YouTube videos and I've read some stuff in the Wall Street Journal. And I come to you and I say, look, everything you know is garbage. I know how to do your job better than you do. Now, that is clearly ludicrous, but it's also what a lot of traders think is true about the Fed. Now, there's three possibilities about what the Fed does. The first is that the economy is completely unknowable to anyone. It's a complex system that literally can't be controlled or predicted. And in which case, the Fed doesn't know anything. You're right, but you don't know anything either, so no one knows anything. The second is that the economy is somewhat knowable, and the hundreds of PhDs that the Fed has working for them have managed to learn a very small amount about the economy. The third is that the economy is really trivial and you know more about it than the Fed. One of those is much less likely than the other. And this all comes back to a very good rule of thumb. If you found a situation where you're convinced that everyone involved in the industry is stupid, it's much more likely that you don't understand the situation. Doubting yourself is really important as a trader. I could be wrong about that, but I doubt it. That's my joke. A lot of traders are contrarians, which means they like to doubt, the established wisdom, and that's fine. But it's not nearly as important as doubting yourself. And a lot of contrarians are these people who doubt everything except their own opinions. Don't become that person. Okay, so these are the things that aren't going to work. Here are the things that will work. I want to be really clear here. The efficient market hypothesis is a real thing, and it's really very good. It doesn't mean, and it never has meant to anyone who understood it, that markets were perfectly efficient. What it means is that they are, to a good approximation, really efficient, and it's really hard to make money. So any edge you do find will be of one of these two kinds. It could be an inefficiency, or it could be risk premium. And it's really important to know the difference between those. I'll give you an example why. There's an old joke about two economists, so it's obviously not a funny joke. And they're walking down the street and they see a $100 bill lying on the ground. And one of the economists said, oh, look, there's a $100 bill. And the other one goes, no, there can't be, because if there was, someone would have picked it up. So that's the efficient market hypothesis. There's no money lying around. But in reality, there is. You will occasionally find a $100 bill lying on the ground. Now, the first thing to do is ask yourself why it's there. If it's Sunday morning and you're taking the dog for a walk and you've just passed a bar and it's lying outside the bar, it's very likely someone drunk came out, dropped it, and went home without noticing it. That's an inefficiency. That's literally something that no one else has noticed. The other alternative is you've seen the $100 bill and it's lying in the middle of a 4-lane freeway. Other people have seen it, but they've decided they don't want to take the risk of going to get it. That is a risk premium. Both of these are perfectly fine ways to make money, and actually you should try and do both, because an inefficiency is not going to last. If you find an inefficiency, the thing to do is trade it as aggressively as possible, as big as possible, and don't tell anyone else about it. Generally, you can tell people about trades, and it really doesn't matter very much. But a real inefficiency, you shouldn't. By the way, this is something that professional traders tend to get wrong. They'll find an inefficiency, and they'll say something like, well, I just want to make steady money, grind away, stay in the game, which is totally the wrong way to do it. The inefficiency is going to go away. Within, could be weeks, could be months, probably years. They don't hang around for decades. So the thing to do is maximize it. Whereas a risk premium is literally something, because it's there due to people's attitudes to risk, it's probably going to be there forever. So that's the sort of thing you can structure an entire career around. That's the sort of thing you want to do steadily, consistently, And like literally, I've been trading risk premium, the same one basically, for 25 years. And I have every confidence it's going to be there for the next 25 years. So if you can find inefficiencies and risk premium and make a little strategy portfolio, then you're really going to do well. That's the ideal. So typical risk premium include the equity premium, and the stocks go up, which is about the best, most well-documented financial fact there is. We've got evidence going back as far as stock markets have existed that stocks go up. You're being compensated for the risk of owning stocks by making money. And after dividends are accounted for, pretty much can expect to make 6 to 10% a year over the long run. So that's a risk premium. There's also within that sub-premium, like smart beta, they're called, factors like value, size, beta, and quality. And people will argue exactly what risk each of these is compensating you for, but it seems likely that, for example, small caps do better than large caps because they are also more risky. They may go out of business. It's pretty hard to imagine Apple going broke tomorrow, but a company with a market cap of 20 million doesn't have to have much go wrong for it. And the final one, which I believe a lot of you people are actively trading, is the variance premium, which is like what I've built my career around. The variance premium basically says that the variance implied by options is too high relative to the subsequent variance. Or, putting it another way, options tend to be overpriced. So the way I think Don alluded to the fact you trade this, a lot of you, is by selling iron condors. So you are selling net option premium. Because on average options are overpriced, on average that trade will make money. But here's something, and I'm not saying this applies to any of you, but it's very important to know where your edge is coming from. And it's not coming from the fact you're doing an iron condor. If you think that's the case, you're confusing the structure of the trade with the phenomenon that's driving the edge. And the phenomenon is that options are overpriced. Your implementation of that is through an iron condor. There's nothing special about an iron condor. You could have done straddles, you could do covered calls, you could do short cash secured puts, you could do butterflies, iron butterflies. There's a ton of things you can do, and they're all taking advantage of the same thing. I'm not saying the choice of structure is inconsequential. It absolutely is. The expected payoff from all of these structures has a different distribution. The important thing is, though, they all have the same average of that distribution. Over time, if you do straddles, if you do iron condors, whatever short vol strategy you do, if you do them the same size, they'll all make the same average P&L. What they won't make, however, is the same distribution shape. There's a lot of things you can do with options to change the shape of the distribution. There are far fewer things you can do to increase the average value of the trade. This is a very complex subject, and like I've literally, I think, got 3 chapters in my recent book about this. And there is no such thing as a perfect strategy. So sometimes people will ask me what strikes they should do for their condors. There's no answer to that. You choose the strikes based on a whole bunch of criteria. Depends on the win rate you want, depends on the drawdowns you want, could depend on the Sharpe ratio you want, all sorts of things. There's no right answer for this. The danger with choosing strikes that are a long way apart, so say selling, I don't know, a 5 delta, 1 delta iron condor, you're going to win that trade almost all the time. Now, that might not seem like a danger, but it really is, because you're not getting a very accurate statistical look at the true risks of that trade. Unless you're very carefully monitoring volatility separately, you're not going to be able to distinguish between luck and skill. And that is a real problem. So I like to do trades that give me feedback to tell me if I'm wrong. And I want to learn if I'm wrong really quickly. So that's one of the reasons if I was going to sell volatility, I'd almost always do things that are closer to the at the moneys, like straddles. But like I said, that is purely a personal preference in that regard. So anyway, the variance premium is probably the king of all options trades. It's kind of like gravity. I'm not saying you can never make money being long options, but you are definitely flying against gravity. Okay, now I'm going to talk to you about a specific manifestation of that. It's something I'm looking at as part of a bigger project. We know the variance premium's there, but just like we know the equity premium's there and we break it down into sub-premium, I'm trying to do that with the variance premium. So the variance premium very technically is basically saying the implied variance swap is overpriced. And that includes all of the options on a particular underlying. But they're not all equally overpriced and they all behave differently. So the variance premium you get from selling, I don't know, a straddle is not going to be exactly the same as the variance premium you'll get from selling a teeny put spread. You are doing different parts of the curve and there are subtle differences between them. So that's what I'm breaking down. And in particular, the thing I'm going to talk to you about today is the skew premium, which is basically the implied volatility skew. It tells you normally that puts trade at a higher implied volatility than out of the money calls. And we're going to show that that exists. And also it is different to the at the money premium you get by selling straddles. So I put this in and then realized I probably shouldn't because I don't really refer back to it. The implied volatility skew is called the skew because you can use it to back out the implied skewness parameter of the distribution. So there is a way similar to the way the VIX is constructed. The VIX is basically a synthetic variance swap. There is a way you can do that to get a skewness swap as well. It uses, again, weighted average of all the options. But a decent approximation for that actually is this, this formula, which is just the difference between the delta of the 25 delta call, sorry, the vol of the 25 delta call and put scaled by the at the money and a normalization factor. That's actually a reasonably good approximation. And it's telling you that the risk reversal is priced in terms of the implied skew. So risk reversals are price reflections of the implied skew. So that's worth remembering. But on the other hand, if you don't, like I said, I probably shouldn't have put that slide in. This is important because there's a quoting convention here, and I thought it was obvious, and then I did this Twitter poll and found out amongst 900 people, it's very much not obvious. Traders almost always refer to the slope of the implied curve of an index, where the puts, say the 25 delta put has a higher vol than the 25 delta call. They will refer to that as being positive skew. Simply because, I guess, positive numbers are easier to work with. But that is representative of a negative statistical moment. So it is telling you that there is a negative skew in the underlying implied from that. So this is always really important with every options trade. Whenever you're doing it and you're talking to someone and it matters, make sure you're on the same page. So make sure that if you're saying positive skew, the other person knows what you're talking about. Okay, so this is what I did. And again, this is about isolating a phenomenon. To do that, you want to do something that works when you do it in about the most basic way possible. So this is absolutely not the way you would actually trade this effect. What this is a demonstration that even using a very, very simple process, there is an effect there. So this is, because it's so simple, it's isolating this as a beta. A beta is just something you can collect. It's a risk premium. So for example, you all know about the stock market beta, which relates the return of any stock to the return of the index. So similarly, there is this beta that can be passively harvested through options, which is the variance premium. Beta is a thing that's there that you discover. It's available to everyone, but you have to know it's there. Whereas alpha, which is like excess returns over beta, is something you have to make. So as a trader, you identify the phenomenon here, which is a beta thing. And I'm showing you that it exists. I didn't optimize these. If I'd optimized them, obviously it would have been like the 23 delta or something. It wouldn't have just come out to a nice round number. But I'm showing you that in the simplest way possible, this thing makes money. So this is what I did. I sold one 2-month 25 delta risk reversal on SPY. So I'm selling the put, I'm buying the call, and I'm saying that the amount of capital I need for this is Reg T margin. So that'll be the margin you get in a very basic retail account. It's literally what the exchange demands you put up. And it's a fairly conservative amount because the exchange don't want to lose money. Often your broker will top that up. So they'll charge you Reg T plus something. But if you're a professional trading firm, you might also get portfolio margin, in which case those guys can pretty much charge you anything they like. So someone like, I don't know, Susquehanna is going to get much, much better margin terms than you are, which I guess is sort of natural. Anyway, so we're going to delta hedge this risk reversal because it's got a 25 delta put and a 25 delta call. It's a 50 delta structure, so I'm going to hedge it by selling 50 shares. I'm going to adjust this weekly because as the SPY moves around, what was 25 delta is not going to be 25 delta, so I have to adjust it. And then when we get to 2 weeks remaining, I'm going to flatten this position and I'm going to roll it into the next 2 months. And this is the result of that. Now, there's a lot of statistics you can use for analyzing whether a trade works or not. And you should use all of them. There's no such thing as a bad risk measurement. The Sharpe ratio, for example, a lot of people think it's stupid because it treats downside moves as equally risky as upside moves. It does, but if you know that, it's okay. It's still a valid measurement. It's still telling you something. There's information in it. It's much better for you to use a whole bunch of different measurements and know the weaknesses in each of them than attempt to find the perfect measurement. So there have been a whole bunch of ways of the Sharpe ratio being improved. In inverted commas, there's the Sortino ratio, the Kalmar ratio, there's alpha, which is a bad name because it's also used somewhere else in finance, the generalized Sharpe ratio. And again, all of these things add something, but it doesn't mean you shouldn't use the Sharpe ratio as well. So anyway, I'm not going to look at the Sharpe ratio right now. This is how you tell a trade's good. It starts here, low on the left, and it ends up here, high on the right. I'm not joking. That's the first thing you should do when you look at trading results. Statisticians make fun of that. They call it chi by eye, because instead of doing a rigorous chi-squared test, you just eyeball it. But if it doesn't pass the eyeball test, it doesn't really matter what else you do. So given this, when you're back testing stuff, you're going to be, kissing a lot of frogs. You just have to kiss a lot of frogs before you, marry a frog. But you have to start with this. And if you go through all of the tests and you look at if you don't do this, you're going to be wasting your time going through a whole bunch of other numbers. So anyway, these are my results. In 10 years, this thing started when I put my normalized initial account value to 100. It ended up getting to 180. Now you notice it hasn't done very well over the last few years, which is, it is what it is. And having said all that about chi by eye, here are the actual statistics. It's made 6.4% return, vol of around 5, slight positive skewness. The important thing is the Sharpe ratio is 1.18 and it has a maximum drawdown of only 5.4. That's really important. In a lot of ways, the smoothness of your results is more important than the actual return, because if it's smooth enough, you can just leverage up to make whatever return you like. And this is a very smooth P&L stream. So we're on to something good. Now we have to test that it's robust, because if it happened to only work for the 25 delta risk reversal, we wouldn't have much. But it actually, if you look here, it works for pretty much every risk reversal you can think of. I haven't showed it here, but it works for pretty much any time period you think of too. So we could do 6-month options, you could do 1-week options. It's a very robust phenomenon. It's saying that puts are overpriced relative to calls. Now, it also works, by the way, for practically every index you can think of. So I looked at a whole bunch of foreign indices as well. And that's important too, because the more confirmation you have of an effect, the more confidence you can have that it's going to work going forward, which is why the equity premium is so believable. I mean, like we literally do not have a period where a 10-year stock investment hasn't made money. Well, you can find it in a given index, but I'm talking worldwide. I want to point out something else here, and then I'm going to ignore it. So if you don't like, if you feel free to ignore it before I even start. You can see that the best is around the 25-30 delta risk reversal. This, it turns out, even though I said risk reversals are priced in terms of the skewness moment, the return on them has practically nothing to do with the realized skew, which is interesting because when you trade an option, you're selling an implied volatility, and that does have a relationship to the volatility of the underlying. There's a direct relationship between the implied variance and the realized variance, and your P&L is driven completely by the difference of those two. Whereas with a risk reversal, there's no relationship to the skew at all. It's priced in terms of the skew, but the P&L isn't driven by the skew. The P&L is basically driven by the correlation between the underlying movement and the at-the-money implied volatility. So what the skew is really telling you is how much does vol go up when the stock goes down. So when people buy puts, it doesn't mean they're stupid. It just means that they think that volatility is going to go up when the stock goes down by more than you do. Now it shows you, these results show you that over time they're wrong, but again, that doesn't really mean they're stupid. It means they're paying more than something's worth, but not necessarily more than it's worth to them. You do this all the time. Every time you go into a retail store, you're paying more than something's worth, but you want it. So that's the price. So that's the same as with puts. Now, it turns out puts are statistically, as we can see here, overpriced. Okay, by the way, I'm not saying anything, I want to be really clear. I'm not saying anything here about teeny puts. We just don't have enough data to know if teeny puts are overpriced or not. So really, really small delta puts, like a 1 delta put, doesn't come into play often enough to know the statistics on it. It's kind of like you're really far out of the money strangles. We just don't know, which is why there are still raging debates over those who say it's overpriced versus those who say it's underpriced based on black swans. And frankly, neither of them have a good point because the statistics just don't back either of them up. We just don't know. We can make quite decent statements around, say, 10 to 30 delta puts, but in the wings, it really becomes a matter of your personal philosophy. And that is just something we're not, if I can't measure it, I can't predict it. So I'm not going to trade it. Let's put it that way. So the evidence we have would suggest teeny puts are probably overpriced because all the other puts are. But other than that, we don't know. And even if they are overpriced, I certainly wouldn't sell them just because my risk tolerance, it doesn't fit in with what I consider a good risk reward trade. Okay, so there is the risk premium. here based on the risk reversal. It is completely different from the risk premium based on selling the straddle. So if you look here, this is what happened if you sold a 2-month straddle and you did exactly the same hedging method every week. You close it out 2 weeks before expiration. That P&L curve and this P&L curve are obviously totally different. So what we are looking here is a genuinely different beta. And that's useful because you can put it together with this and make a diversified portfolio. But why I'm doing this is because right now I'm trying to work in a Delta 1 environment where I'm trying to essentially improve an equity portfolio. And the cool thing about a risk reversal is if you don't hedge it, it's entirely directional. So you can stick it in an equity portfolio and improve things. So here is a 70-30 split between the spiders and my 25 delta risk reversal. So I'm literally replacing 30% of the directional exposure of the spiders with risk reversals. And as you can see here, I'm getting a slightly lower return, but that's because the return of that risk reversal strategy is lower than the spiders. On the other hand, I'm getting a much better Sharpe ratio, so I can more comfortably leverage this, particularly because the drawdown is considerably less. So the important thing here is the Sharpe ratio, which tells me that I can leverage this. Also, if I didn't do it here, but if you just look at the graphs, you'll see that even though this has a somewhat comparable volatility, it just in every other eye test is a much, much smoother thing. So here's my conclusion before you start yelling at me in the questions. Short risk reversals do have an edge. It's an independent edge to the variance premium, and both of them can hence be added to enhance an equity portfolio. So that's all I have to say. It's an example of how you can start to find a statistically valid trade. There are lots of things you can do. Now you've found that, you can work at ways of scaling in and out of the trade, because, little hint, if you look at it, you'll find it's very strongly mean reverting, so you can trade it like you would any other spread. You can play around with exact strikes, and you can see that it doesn't work exactly the same in all market environments. That's alpha. That's something that you personally can add, but the important thing is to add it on top of something that you already know works, and this is something that works. So thanks for listening. I guess now I'll throw it back to Dom to see what he has to say.
Tremendous, Ewan. A lot of insights there that I think spoke to a lot of people. And let me ask a couple of general questions myself, and if I may, and then we'll get some other people involved. It's really one question that I just, it may be a little bit different between the way you trade and the way some people here trade. Am I correct that in your book you suggest that for traders who are perhaps not as professional as others, dynamic hedging or any form of adjustment, that's my question, may be best avoided?
That's a very good question. I don't mean that in the way that, you see people go on Shark Tank, and every time one of the sharks asks a question, whether it be good or stupid, they always say, oh, that's a great question, because that's what you're told to do in business school. I mean that, it's a really good question. If you don't do any adjusting at all, you're not going to be trading volatility. So for example, you sell the at the money, say the stock's worth 100, you sell the 100 straddle. If the stock goes to 200, you don't have any volatility exposure left. So if you want volatility exposure, you have to adjust your position, whether you adjust it through options or whether you adjust it through dynamic hedging. It's a different question, but in either case, you're doing the same thing. The tricky thing for everyone, actually, not just retail traders, is every time you do that, it costs money. And costs are a very insidious thing because they're always there and they're always small. So your daily P&L swings might be, I don't know, pick a number, $1,000. But your costs every day, it could be only like $5. So you don't notice them on any given day. But that's $5 every day, whereas the $1,000 is plus or minus 1,000. So every time you trade, it costs you money. So the trick is to balance the adjustment with the cost. So you always want to balance what the adjustment's worth to you with how much it costs, which is a very difficult problem. And that's something pros don't do well enough either. Pros have lower costs, but they're still there.
There seemed to be excellent point. There seemed to be a whole bunch of so-called strategies being offered or being used and actively traded in the group or the community that we find ourselves in often, which comes out of certain educational organizations and other places, which consist of, well, first of all, delta hedging, where it gets a little bit out of delta balance, but also putting on more aggressive hedges dynamically as the position moves sharply. In other words, certain people that seem to be very successful have like stop orders and open orders to add, let's say, long puts or put spreads dynamically as the market goes down. Therefore, they're saved the cost of putting them on initially. They get them maybe cheaper, maybe not later on. And they'll accumulate those. And in some cases, they seem to be able to do that to catch market crashes and so forth by that kind of just-in-time added hedge. But theoretically, that shouldn't work if we believe the efficient market hypothesis or theory. Do you think there's any chance it might?
Yeah, I wouldn't go so far as to say theoretically that shouldn't work. If you can definitively say that, then I'd say your theory isn't rich enough to capture what the real world's like. I don't, how do I put this? Every time you do a trade, you're making a prediction. So it's quite possible that given those traders' predictions, that is a good thing to do. It's nothing magical about adding to a position. And in fact, you shouldn't even think that way. What position you have on at the start is kind of irrelevant once time goes by. You should always be asking yourself, given what I know now, given what my best forecast is, what position do I want? And then if you don't have it, well, you do whatever you need to do to get it. So, if the market goes down and these people decide they want to sell a put spread, well, I mean, that's fine, but it's a separate prediction that could well be right. Again, there's no magic about the put spread. Essentially, they're trading mean reversion at that point. So they're saying, given this market moved down, I think the market's going to go back up again. Maybe they're right. There are certainly effects like that in certain markets. So all I'd say there is to me, that's not intrinsically stupid. It certainly doesn't go against, my view of the efficient market, which is that it's hard to make money, but not impossible. But I would really encourage you to stop thinking in terms of position adjustment or the worst one is repair. Because, repair means you're going to fix something. But with a trade, you don't need to fix it. You can just get out of it and get into a new one, which is what you're doing. And that way you start with a clean slate rather than trying to sort of, say, I've got this put spread, what do I do? Well, you don't like the put spread, get out of it. It's not like a family heirloom. You don't have to keep it.
Correct. So just to understand what you're saying, make sure I understand it. And you're saying that, and by the way, I was more thinking of buying a put and when the market moves down, but your other example is equally applicable. But so you would say there is no real role for trading your equity? You should only trade the market and not your equity?
No, I'm not saying that at all. You should base the size of your trades on your equity all the time. And okay, so this is probably something that I can't explain very well orally, but I'll give it a go. Okay, first, you shouldn't ever have to be in a situation where you stop yourself out because you've lost money. If you do that, your initial trade was the wrong size. You should stop yourself out of a trade when you're wrong, i.e., if the market is now, if your forecast of future movement is different and inconsistent with your position, then get out. The money's gone. That shouldn't be part of your calculation. Now, there are times when you losing money is correlated with you being wrong. Like if you're a trend follower and you think the market's going up, so you buy something and it goes down, you are both wrong and you've lost money. But where it gets trickier is if you're a reversion trader, so you think things are always going to come back to their mean value, then as you lose money, you want to add to that position. Because look, if I think something's worth 100 and it's 95, I'll buy it. But if it's now worth 90, I want to buy more. I don't want to get out. So I've lost money, but I still want to do more. So you have to size your trades based not only on your equity, but on your strategy. So if it's mean reverting, you have to allow yourself to be able to scale in and out, because you don't want to run out of bullets when the edge is the greatest. So yeah, equity is really important. It's a major part of it. Has to be dealt with in context of your strategy.
Thank you. I'm not going to say too much more, but let me ask just one or two more quick questions, and then I'll open it up to everybody. Have you seen? I mean, we have the point being made here, and it's completely valid, or at least I think it is, that a lot of traders are trading very wrong. You mentioned both some professional traders as well as some less professional traders. They have misconceptions left, right, and center, and presumably these are a major handicap to success. Do you see some categories of, I don't want to say retail trader, but less professional trader succeeding? And what kind of trades, like we mentioned butterfly trades, we mentioned iron condors, we mentioned risk reversals. What kind of, do you see any pattern to the type of trading they're doing that is within reasonable grasp, that is with reasonable grasp that they can attain?
Yeah, I think anything that is based on the idea of harvesting a risk premium is going to work over time. So there's a lot of things you can, if you're buying equities and you buy on the dip, I mean, that's a good thing to do, but it's mainly a good thing to do because it's a good thing to buy equities to start with. So once that's your strategy, you've put yourself in a position where you're more likely to succeed. That's obviously a long-term thing, but that's the kind of thing you have to find. You have to find this general phenomenon and then base the micro bits of your strategy around that. So like, yeah, selling iron condors, you're going with the flow. That should work. And if you know why it works, which is because of the variance premium, then you can be like, okay, that's how it works. Now, given what I know, how do I make it better? So I really think in order to make something work, you should start with something where the tide is in your favor. And also, you've got to beware here that a lot of the things traders say, even really good traders, are just nothing to do with why they're good traders. So it's really difficult to learn from a trader just by listening to what they say, because what they do is correct, but the reasons they give you might just be stupid. So the example I'd use is if you're stuck in the desert and you need water, you don't want to go to the geology professor who knows everything about where water theoretically should be and how it's formed and what rocks to look for. You want to go to the tribesman who lives in the desert because he knows where the water is. He might have no idea why the water's there, but that's not what you're interested in. So there's a lot of traders who think they do one thing but actually do another. And they're good to know about, because it means what they're really doing is a really robust strategy. So if you can take that thing that is clearly working and make it better because you know something, you understand it, then that's a really powerful thing. So a lot of things that pros do, like market making or stat arb or risk arb, I mean, these are all perfectly sensible strategies and they do work, but they're not very applicable for retail. So I think on the retail level, where costs are much more of a factor, and the difference between retail and pro isn't ability, it's basically transaction costs. And I'll include also in that the implicit cost of watching the market. Whereas if you've got another job, you can't sit in front of your screen all day. So that's an important thing as well. But anything that involves buying stocks in the long run, or trading mean reversion in the medium term, or selling vol, all of these things are great places to start. It's one of the reasons covered calls have worked for so long. You're selling volatility, and you're combining two things that work. You're combining the equity premium with the variance premium. So it's like a portfolio of strategies. It's a great place to start. But unfortunately, a lot of people think covered calls work for the wrong reason. They think it's like, oh, I'm creating a dividend or something, or it's income or something. So the covered call will still work, but you can't improve something unless you understand why it's working.
Well, that leads me to, I think, will be one of my final questions before I open it up. And I apologize, but I just like to try and keep things in order a little bit. And that is, your books, particularly the first one, I think, have a lot of math in them, and that's not necessarily an obstacle to everybody by any means. There have people here who have PhDs, but how much help is it, or to what level or depth of sophistication of trading does one need to get to before finding that math, the detailed math of the models of Black-Scholes, and of course, much more in depth on the strategies? Do you use it routinely? Do you find it helpful? Would you recommend people, understand modeling to that extent mathematically?
That's a little difficult for me, because I've pretty much always done math. So for me, math is sort of language I speak. So it's difficult to know exactly when I'm using it and when I'm just kind of thinking in those terms. I don't, though, think you certainly don't need to know Black-Scholes to trade options. If you're going to start hedging, and you have to know about the Greeks and so forth, it helps to know the math, but you don't have to. There have been explanations of those things written that don't use the math. So I don't think mathematics is essential ever. It's helpful to know statistics because then you can really analyze your results properly. But the math behind Black-Scholes, which is stochastic calculus, I mean, you don't need to know that at all. You don't need to know how to derive Black-Scholes in order to benefit from the insights behind it. Really what they did is they took an observational insight that you can hedge an option and then mathematized that to come up with the value. So what you should do is say, wow, that's really clever. Now I've got a piece of trading software that does all that for me, so I'm good to go. So I use math. And it helps when you're reading papers, which I get a lot of ideas from. I mean, there are a lot of good published things out there, but you can also, if it's a good paper, you can read it by sort of reading through the equation. You should be able to, well, I certainly try and write so that you can not have to understand the equation. You can just go from paragraph to paragraph. And I think that's the important part.
Very good. Let me pick up on a couple of questions we have in the transcript or the chat, if I may. Let's see. Okay, here's one from Samir. If you notice a huge skew develop in an asset, would you, and I know you mentioned finding edges, Ewan, that are limited in time. If you at some point noticed a huge skew developing in an asset, Samir says, would you build a trade off it right away? What is your process?
That is a very good question. In indices, I can pretty much tell you, tell me the at the money volatility level, I can pretty much tell you the volatility level for any delta option from that because the skew is so stable. Now that implied skew number does move, but it doesn't move very much. So in that case, if the implied skew goes up a bit, then I'll sell more risk reversals. If it goes down a bit, then I'll buy some back. So you can trade that as a mean reverting process very successfully, very easily. That's a really easy way to improve this trade. With single stocks, it's much more nuanced. And there's a lot of studies out there on it that they've shown that there is certain predictive power if you see a big implied skew move. To be honest, I don't trade single stocks enough to know what that prediction is of, but it is out there, it's been studied. So if you're going to do that, yeah, there's information in it, definitely. I couldn't tell you what the information is. People have related it to directional moves as well. It's like, you know, the old, it's called the put-call ratio. Well, the put-call ratio is basically a contrarian indicator, right? It's telling you that if people buy lots of puts, market's overdone and we're going to rally. Well, if people buy lots of puts, it means the skew is going to be steeper. So typically, if the skew steepens, you would make a bet where you're selling volatility and you think the stock's going to go up. But again, that would depend very much on the individual underlying, particularly with commodities. Commodities, you probably want to know the fundamentals. With stocks, probably doesn't even matter that much.
Let's see. A couple more. Do you have time for some more questions?
Oh, yeah, I'm good.
Oh, great. Here's one from Jay Hansen that's a bit specific. In your book, you said a long risk reversal with a teeny for hedge was one of your favorite long strategies. What principles do you apply to select the teeny strike? Do you put it on for a net credit? And how do you decide when to close the trade?
Okay, so that's all really related to what I've just talked about here. Okay, so there are theoretical ways to select the strikes. A friend of mine, Arta Sepp, has written about this, published it, and we're currently working on some stuff together, but it's difficult because he's in Switzerland. He's shown that this is, the profit here is linearly dependent on the VANA of the option. So the VANA of the option is how much the delta changes as the spot changes. And given the implied skew, you can find the options with the greatest magnitude of Vanna. And those would typically be the best ones to trade. So that would depend on exactly how steep the skew was. Typically, you're looking at options in the 15 to 25 delta range, but it depends exactly on the steepness. So that's how you would find it theoretically. And then honestly, you just test it, see which ones work the best. What was the other question? When would I close it? Was that right?
Right.
That's trickier. Generally, the place you would close an option is if it's a short option, you would close it as late as you possibly can, because the variance premium in percentage terms gets greater and greater. So you don't want to be buying back a teeny close to expiration. Sometimes you have to. So you only close those shorts when you have to due to margin. With a long, you have to make the trade-off, you have to balance, is the cost of carrying this now bigger than my expected edge? So if you think like the market's going to go up, I don't know, 1% a day, and you've got a 50 delta option, you expect that option to go up 1%. Just say it's going up $1. You expect the option to go up 50 cents. But if it's got an 80-cent theta, you're expecting, based on what you're expecting to lose 30 cents on that option. So at that point, when the theta is overwhelming the amount of edge I think I have left, that's when you'd get out.
Okay. Oh, he did ask, would you place it at a credit?
Well, typically you always do, because when you happen to look at the strikes, you're almost always selling puts at a higher price than the calls you buy. In fact, for an index, I don't think I've ever seen a situation where you're not getting a credit.
Jay Crew was asking, did you make, I'll just read it as he wrote it. Who wrote the paper you're talking about now? I missed the name. I think I'm not sure if we remember anymore.
The paper I just referenced about the theory of the risk reversal, that's Artusepp, Artursepp.
Thank you. Yeah, I'm sure that's what he was referring to.
It's on SSRN somewhere.
Okay.
He hasn't actually published these, they're working papers.
Excellent.
He's tidying up the theory and it's going to appear in something we're working on right now. But yeah, it's on there.
Jay, why don't you look it up and post the URL if you feel like
his notation is awful, by the way.
And while we're talking about papers and books, Alexander Ivanovich asked, besides your books, what communities, paper sources, code sources would you suggest?
In terms of papers, SSRN is by far the best. It's got a really good search function. I also search there literally once a week, I'll go in there and I'll type in option and see what papers contain that in the abstract or the keywords. And I'll see which ones came out last week. And I'll do that for a few other keywords like VIX, volatility. So SSRN is probably the best for finding new stuff. Google Scholar is good if you're looking for something particular. And one of the things I like to do on Google Scholar, I do this at the weekends because I'm a huge nerd. Find a paper you like, type it into Google Scholar, and then look at all the papers that have cited that. And that's quite a good way to find new works. The archive, arxiv.org, I think.
Yes.
The quant finance section in that now has become very computational. There's a lot of stuff on machine learning and neural nets and stuff. And I'm not saying that's not valid, but it's difficult to get insight from it because you're literally talking about black boxes in a lot of cases.
Yeah.
So it's not as good as it used to be. In terms of code, I don't know, to be honest, because I don't really use anyone else's code. Internally, we use, we have our own stuff written in Python and R, and I tend to use that and a lot of legacy stuff that I've got in VBA still.
You mentioned machine learning. I noticed you had some venture in that area, I believe, or have. What is your overall opinion of whether machine learning can have any relevance to our type of trading or any type of trading?
Well, it absolutely can, but it's a technique, and you have to be really careful you're applying the right technique to the right problem. Like this, in a lot of ways, you look at the archive, for example, and you'll see a machine learning paper applied to trading, and then you'll note that it comes out of the physics department of somewhere. That's probably a case of someone who's got a hammer and decided the problem's a nail. And we've seen that a lot over the years. Like before I got involved, the big thing was catastrophe theory, and that was going to make everyone rich. And then it was chaos theory. And then it was neural nets and genetic algorithms. And everyone gets wildly excited about these, and the excitement never pans out, but they become solid mathematical techniques. Like a neural net, for example, I mean, it's exceptionally good at some things like pattern recognition, reading barcodes. I mean, the world wouldn't be the same without them. But they're not very good at predicting stock prices.
No.
So it's a matter of finding a good problem. So machine learning is absolutely a useful skill. Not sure it's the most useful. I think you can get by without it. I don't know of any, for example, really successful trading. None of the big trading firms are basing trading decisions on it. I mean, the option trading firms.
Really?
Well, they're using it to enhance things that they do already.
Right.
But they're not just setting a machine learning algorithm loose and having it buy and sell stocks.
Well, that's fascinating for me to hear. Who else would like to chat with Ewan for a minute while we have him here? Sometimes.
Do you want me to look at these chat questions, or are you doing that? Are you curating these?
I've been through most of them. You're welcome to check for anything.
I'm happy to read
Go
my
ahead,
one
John.
I just typed in. This is John. Thanks for joining us, Ewan. In your opinion, what would you say the best way to fully utilize the available cash of an options trading account would be, given that many options trades necessitate small sizes due to, say, large risks associated with those trades?
That's a really difficult question. I mean it's a difficult question because it doesn't really have a good answer. One of the problems I have, it turns up a lot, right, is you have a strategy which involves using some money, but you don't know how many of these trades are going to turn up at any one time. So there's something I'm doing now, which you'll get a signal in it maybe once a week, but it's got a holding period of like a month. So you don't know how many of these are going to turn up and how many you're going to have. So you get into a really tricky situation as you don't know how to size things because you don't know what your future opportunities are going to be. So honestly, I'm not sure I can say much about that. It's a really difficult problem. I don't really know what the answer to that would be. I mean, if you know you're always going to have these positions on, then it's easy. You just allocate the margin in the size that you want. So, you might want to allocate, I don't know, 80% of your margin to short VIX futures and 20% to, I don't know, whatever, 20% to something else. But generally, life's not that, it's not that simple. So sorry about that.
Sure.
If you find out, let me know.
Yeah, appreciate it.
One question I see, I don't think we're going to be able to get to all of these. I think some of them might be better discussed afterward among ourselves, and we'll come back to those. but Steve Patensky, or I hope I'm Patensky, asked, do you do a lot of VIX term structure trading?
Okay.
I think the answer is yes.
I trade the VIX. So if you're trading the VIX, you have to be taking term structure into account. A friend of mine, Crilly Dollinger, was one of the first people to work on this, and we kind of worked on it together. He called the strategy the Mojito, and that was basically a term structure, ETF trade. And that was, I don't know, 2008 or something. And Simon and Camposano's paper was similar time. But it's like one of those things, right? I mean, a whole bunch of people sort of came up with this at the same time because the idea was there in the idea reverse. Yeah, if you're trading the VIX, you have to be aware of what the term structure does because it's a real effect. And it's one of those effects, actually, that's really good because it's a mathematically driven effect. So you know it's going to be there. Where you get into trouble, though, is, see, 10 years ago, when people were trading VXX or any of the other VIX ETFs, they had no idea about the term structure. Now everyone thinks about the term structure, and it's kind of gone from underrated to overrated. It is an effect, but it's not the only effect. So you can calculate exactly how much, given the term structure, the decay should be each day. But there's other effects going on as well. So yeah, you do have to take it into account, but you have to take it into account along with other stuff. I mean, most notably, what the VIX futures themselves are doing on their own, although there's a term structure there as well, and what the VIX is doing. And also the VIX on a short-term basis is basically driven by the S&P. So it's one of those cases where you've got to make your trade based on what you're really predicting. So if you're like, for example, yesterday, I tweeted about this morning, actually. Yesterday, if you're like, vol's overdone, I'm going to sell some of these VXX ETFs. Okay, so you're saying vol's overdone, why? Basically, because you think the VIX has gone up too much in a day. But that VIX spike was driven almost entirely by the fact that the S&P went down. So it's probably better in that case to just buy the S&P, because otherwise you're fighting against the term structure in VXX rather than using it to help you. So I guess, yes, I do. Yes, it's important.
Very good. Ron, did you want to ask? I know you had a couple of questions in there. Do you want to ask them yourself?
Can you hear me?
Yeah.
Yes, I can now.
Great. Hey, Jon. I really just had one question. I was curious with your backtest that you showed. Does each data point on the equity curve there represent end of trade P&L, or did the summary stats also account for intra-trade drawdowns and when you're looking at max drawdowns and Sharpe ratio and so on?
Oh, you mean these little dots here? Each dot?
Yeah. Does that account for intra-trade?
That's end of day.
Okay.
Also, I can't remember because we've done this a million times in lots of different scenarios. I'm not sure if this includes transaction costs or not. It doesn't make a huge deal of difference for the SPY because transaction costs are so low, but that's something you'd want to take into account as well, obviously.
Okay, thanks.
I like your avatar, by the way.
Very good. Let me see. There were some others. Mark, what was your question again? Oh, yeah. Do you do anything with positive Vega trades?
They're a lot harder to find, aren't they? Because you are swimming against the tide. Let me think. There are some. Try and find a couple of examples. In general, you can find short vol trades by looking at statistics because you're literally making the bet that the future is going to be just like the past. Whereas with long vol trades, you're normally making the bet that something new is going to happen. something that isn't priced in based on the past. So you can't just do time series analysis to find it. I think the only one I can think of off the top of my head, and it does happen, VIX puts, based on the downward drift driven by the term structure and VIX mean reversion sometimes, VIX puts I quite often am long. Not when the VIX is at 13 or something. But if the term structure is favorable and the VIX is say 24, 25, being long VIX puts is a good trade. If you're long, I do want to say you're better off buying long dated options because the variance premium out there is always lower. So even if you don't think there's a variance premium, because if you think, for example, I think those puts statistically are cheap, you still will get a better deal with the long dated ones. The other place that I sometimes buy options is in earnings plays for single stocks. It used to be that stocks where analysts were pretty much all in agreement about earnings would have much bigger moves, because essentially any miss was a surprise. So it was literally not going to be baked into the option price. That doesn't work as well as it did 10 years ago. I mean, what does? But that will sometimes be a situation where I'd go long. Also, single stocks, they generally have a variance premium, but it's some classes of stocks don't seem to. So it seems like options on growth stocks have a much lower variance premium. So that sometimes leads to long vol opportunities. But that's a much, much less explored topic than, say, time series analysis, which is probably a good place to work, actually. If I had nothing else to do and could sit down and do whatever I liked, I'd probably look at volatility related to fundamentals of stocks. So it really, I think there's like 5 papers written on that. There's probably a lot to learn in that sphere that hasn't been pumped out yet.
Okay, let me just see. Oh, here's a simple one from Gurkha and Aurora. In your opinion, in what order should one read your books?
I would go option trading, volatility trading, positional option trading, with the caveat that volatility trading is largely aimed at market makers because it discusses dynamic hedging in quite some detail, whereas positional options trading is mainly for quantitatively oriented buy side. So people who will be trading options but don't want to be actively managing them as much. And the amount of background you need for vol trading and positional option trading is probably similar.
And Mark was wondering, well, I know the answer to this, but about calendar spreads. Do you look for, his question is, he meant to ask about calendar spreads. Do you do many calendar spreads?
I don't, and I probably should. When I was doing the last book and running simulations about what happens under various circumstances, calendar spreads had a lot of interesting things going on that I hadn't, it sort of surprised me. Coming from a market making background, calendar spreads are really dangerous trades because a lot of market makers will do a trade, say, a 2-year, 3-year straddle swap. Because frankly, a 2-year option and a 3-year option, kind of the same thing. The problem is when you get close to expiration and that becomes a 1-month option against a 1-year option, you have all sorts of problems. And I've seen so many market makers get into such tangles with positions like that I've kind of tended to avoid them. And I think that's a mistake. I think as a positional trader, there's probably a lot of good things you can do with them, which, to be honest, I really haven't.
Okay, Ruben Brooks says, for VIX volatility or index trading, do you find value in incorporating information beyond price and volume of the different instruments, e.g. macro indicators or proprietary data feeds?
Okay, so there are in some cases, yes, like if you're going to price S&P options, knowing about, say, the VIX options, the skew index, they can be useful pieces of information. So there are sometimes things that are linked like that. As I said, I would like to get more deeply into looking at the way stock volatility is related to fundamentals. So how stock volatility changes with the P of the stock or the size of the stock or the industry and all that kind of stuff, but I just haven't. I think there's a lot in there. I mean, I've got my intuition, which could well be wrong, is telling me that that's a really good place to look. But I'd really say the cross-index stuff, sure, yeah, and the VIX with index stuff. I mean, if you're going to make like a Garch model for predicting vol, you can certainly include, you can make it multi-dimensional and put in, VIX as well. So I often do that kind of thing.
And that's very interesting. Well, I think you're going to have to go fairly soon, I assume. I realize you're running hedge funds and everything else.
Well, yeah, not right now. I'm not. No, I'm good for a bit longer.
Okay, great. Well, we got a couple more questions here. And let me just see. This person.
Do you mind if I ask something, Don, while you
Please do.
Ewan, one of the questions that was asked before, I think, wasn't perhaps interpreted in the way that I think that it was asked, and by this other person, and it was that question that they asked you about doing a risk reversal and then buying a teeny. The question was actually about how are you choosing that teeny, whereas your answer was regarding how to choose the strikes based on Vanna for the risk reversal?
Yeah, okay, sorry about that. They are very different processes. So that's a situation where first you get the edge, then you get the hedge. So the edge is coming through the risk reversal strikes, the 25 delta, 25 delta, say. But obviously, if you're short 25 delta put, it's completely rational to want to cap your downside. So you buy a teeny put somewhere below that. That's fine. The thing is, at that point, you're doing a trade that you know has negative expectation. Everything you know about the variance premium, and even the fact you've sold a risk reversal in the first place. You're saying that the 25 delta put's overpriced. Well, probably means the 5 delta put or the 2 delta put's also overpriced. So you're not doing that trade for the same reason. So what you have to do there is, well, you don't have to do anything, right? But what I do is I'll literally say, how much money am I prepared to lose on this? And you don't put probabilities on that. This is one of those situations where you have to have completely, incompatible thoughts in your head. When you're doing a trade to get edge, it's all about probabilities. But when it's a hedge, the probability of the bad event doesn't matter at all. What matters is the outcome of the bad event. The S&P's never gone down 50% in a day. Could it? Sure. It just hasn't, but it certainly could. It's very unlikely that we've seen the biggest crash ever. It's like going fishing and thinking the biggest fish you've ever caught is the biggest fish that could possibly exist. So it doesn't matter what the probability of a 50% drop is. It matters, can you handle losing that amount of money? So that's what I do to choose the That's what I do to choose the short strike. Sorry, the long strike. Just choose the amount of money that I'm comfortable with losing. Yeah. And that's a, that's a risk tolerance thing. It's completely up to you. There's no correct answer about that. It's not even a matter of like a trade sizing algorithm, like a Kelly criterion thing, because the amount of money that you could possibly lose probably isn't really related to the amount of money you'll probably lose. So they're different decisions again.
And with the hedged risk reversal that you showed for the equity curve there,
Yep.
is that, I forget with your bullet points, is that hedged daily? Delta hedged daily?
No, it's delta. It's okay. So we assume the target position is a 50 delta risk reversal hedged with 50 stock. We rebalance it, which is essentially equivalent to rehedging it weekly. However, I've done other studies doing it daily, monthly, letting it slop around within a certain delta hedging band and so forth. And it doesn't change the general conclusions. So obviously, if you do it based on a slightly different algorithm, you'll get a slightly different result. But again, we're only looking at one price path history. So you don't want to read too much into that. It's really important that it kind of works in a variety of situations. But I wouldn't like say, well, the best way to do it in the past is hedging every 3 days. So that's what I'm going to do in the future. I wouldn't trust it. I wouldn't trust the future and the past are going to be that similar.
Very good.
Right.
On anything else?
No, actually, the only other thing that was floating in my head is just out of curiosity is if you've combined those two concepts. In other words, doing the delta hedged version, but also with the teeny as well.
I didn't in this. It just doesn't, because I'm looking at trying to make this into a Delta One product, it just doesn't fit within that context. So no, I haven't directly compared that.
No worries. Thanks.
Okay, thank you. Steve Polensky again. In your new book, you suggest strike choice might be driven by the dollar put premium due to volatility skew rather than puts with the highest implied volatility. Is that correct?
That is what I suggest, and I'm not sure I believe it as much as I once did. It certainly gets you in the right ballpark. For indices, it's going to put you in that 15 to 25 delta put range. The reason I don't, it's a pretty good place to start, let's put it that way. And it's also a pretty good trade-off between the most edge, which is selling the ones with the highest volatility premium, which because of the skew is typically going to be very, very low delta options, and the best risk profile. So yeah, I kind of end up in the same process, or sorry, the same part of the curve still, but possibly for different reasons now. And I'm possibly looking for different things now, but it's a very good rule of thumb.
And I think we better let you go, but Jay, because I said an hour and a half originally, but at most. But Jay Hansen, let's get his question in. Although I can tell him, I can sort of answer it. Well, Jay Hansen says, what principle do you use for determining position size? Now, that's actually a major subject in your book, but is there anything you would want to say briefly?
Yeah, there's a lot going on with that. I'm going to say I use the Kelly criterion, but then I'm going to be really clear what that means. The Kelly criterion is not return over variance. That's an approximation to the Kelly criterion that doesn't apply very well to options for a couple of reasons. The first is that the P&L distribution of options is wildly different from a normal distribution, which that approximation requires. And secondly, the variance itself in options is mean reverting, which again, that approximation doesn't take into account. So I'm going to say I use the Kelly criterion because I'm talking about ways of maximizing logarithmic growth, which is really what the Kelly criterion does. And all of these other things are just specific implementations of it. So yeah, there's a lot in there, but I definitely start with the Kelly criterion. And I keep going back and forth about whether I should write a book on that or not, because there really isn't anything that answers all the questions that I want answered. The problem is I don't have the answers to all the questions I want answered yet. So any book's going to have to wait until I figure out everything. But yeah, that's where I start.
Wow, you're prolific in so many different ways. If people want to keep in touch with you, you mentioned you have a Twitter feed, you?
Yes. And I'm not sure what my handle is, to be honest. I think it's at Sinclair Ewan. Let me just check. Yes, it's at Sinclair with a capital S, Ewan with a capital E.
Okay, well, could somebody look for that and paste it into the transcript to verify us that we got it right? Fantastic. And we've taken a lot of your time, you and I don't want to abuse the amount that we asked for. And
Okay.
are there any other points you'd like to make, or are there any efforts you're looking for subscribers to?
No, not really. If you follow me on Twitter, you'll see the blogs I write for the business. I'll post the links there. I mean, I guess all I'd say, if I had to summarize what trading was all about, is find an edge and then know why the edge is there, and then everything else will flow from that. It's like you'll know what structure to do. You'll get a much better idea of when it's not going to work. You'll get a much better idea of the sizing process to do as well. But you've got to start with that. You've got to find an edge.
Absolutely. And by the business, would that be Hull Tactical?
Yeah, Hull Tactical Asset Allocation. Sorry, asset management.
Asset management?
Yep.
And what is their business?
It was set up by Blair Hull, who was one of the the original floor market makers who made an enormous trading firm from that. And it's essentially an asset allocation, it's a money management firm that, I mean, we trade basically S&P options and VIX options and equities.
And are you looking for customers or?
I think for compliance reasons, I'm not going to say anything about that. I don't want to be seen to be pumping for money, but I mean, we're certainly, well, you can figure that out, I think.
No. I didn't mean, I put it wrong.
Yeah, this is the first time I've worked for an outside money management firm like this. And I usually run afoul of compliance a couple of times by Tuesday of each week. So I'm really just not used to it. I think they'd be happier if I never said anything.
Well, it's nothing compared to what we've seen with some participants. I won't go into any details. Thank you very much. We're going to continue with our own discussion. I'm going to go over some of my impressions of your book, some of your books. I doubt you have any more time. Thank you very, very much.
Thanks. I appreciate you asking me.
You're very generous once again. Thank you. So we'll say goodnight to you for now. We'll continue. Let me just see if I can share something I have here. And let me see, how do I do this? And share screen. Green one, this one. So hopefully you can see on my screen. Can you?
Looks good, Don.
Okay, thank you. So I thought for a long time that we should do some reviews of books, because we can't always get the speakers. And also it allows us to take a little more leisurely approach to things. So I just want to partly also use it as a lever to get some discussion on some points that I think are either excellent or good, or perhaps not so, are more controversial. And so that's his latest book. Has everybody got the notion that the variance premium is the volatility premium, the same thing? The let me just say it, namely the excess that you can hope to harvest from overpriced premiums. A variance swap is that different. It's the difference between the current, I think, implied volatility or volatility, and what is realized. And you're looking for, I'm sorry, are the predicted volatility at a future date. A skew swap would be a swap of skews. One of the that's just terminology. I don't think I'll dwell on it. Some people are going to get it, some aren't, and you know that's just as it is. And one really interesting point, people were talking about VIX briefly, and these are points in his book that I'm just suggesting. Struck me as interesting. If you disagree with them, please just say so, or whatever. One of the very interesting points that I thought that I learned from the book was that VIX. The question comes: the spot VIX, which is an implied number, it's not a tradable number, is usually different than even the nearest future. The nearest future is higher. And as they converge, you get a lot of convergence splashing around as the next future month moves into the present. And which of those is right, the future or the spot? Now, let me see, what did he say was right? I think he said that the spot, I'm pretty sure he said the spot, that the present value of the VIX is right. So there's a real possibility there as that VIX comes down from the into the present to do some trades with that. And he said, we have the question, if you look at, if you're selling some out of the money puts, which is really the engine of profit in a lot of the trading we do, selling puts, and where is that advantage that we're hoping to harvest coming from? He says half of it is from the skew and half of it is just from the variance. So that's another interesting fact. Another point that I found very interesting in his book was he looks at the variance premium. We know it exists for stocks, or rather for indexes, even better. Does it also exist for commodities? Yes, it does, he finds. And he found that in his studies and his references that natural gas had a 10% nice high premium. S&P 500, I get the impression it's around 4 or 5. And then we find that some of these commodities, crude oil, heating oil, SB is sugar and corn, had a good, at least decent size, reasonable sized variance premiums, excesses of prices of stocks, of options on these commodities that could be harvested. And also he has correlations there. The grains being the least correlated with the S&P. And the reason you like that, you want small degree of correlation, is for diversification, reduction of risk. So this holds out a lot of promise to my mind, and for diversifying our trading. We do too much of it in stock indexes, the S&P. We need to do it also in other underlyings. One interesting thing that you'll find in his book is he states what trading strategies he trades as the core of his portfolio, and those he calls the highest confidence trading systems. And these are this is what is listed in the book. And he lists VIX options. He says sell them if it's in contango, buy them in backwardation. And he has a whole thing about factor-based investing. In other words, he's looking to buy calls or sell puts on low PE stocks, on high price to book stocks. And I have the list there. So you'll find that the details at somewhat great length in his book. After positive earnings by a call spread. So he gets into some of these earnings trades. Has anyone experimented with factor-based investing in options trading?
Don, I didn't read the book, but the factor-based investing seems kind of out of left field for this guy. Where's the volatility play in that?
Well, he actually has studies for each of these that show that it isn't a volatility play, I think.
Yeah, exactly. It's a separate way of investing.
Mm-hmm.
Oh,
Yeah.
great. Okay.
I guess he's talking about diversifying beyond pure volatility plays.
Yeah.
And
So I remember he mentioned risk premium as well, which equities would fall under. So,
yes,
but
he
then
did.
when it comes down to saying how do you do that, then he's suggesting that using factor-based investing can help you get on that train, right? In terms of the selection of the specific stocks by using factors to help you isolate the choice of stocks that you're going to invest in.
Oh, that makes perfect sense. Thanks.
So exactly. I mean, I think getting that, I mean, we might have heard that from other people, but to hear it said by somebody who is an option volatility trader primarily, it gives us a real good clue that may be a good area to look into. And if we want to are at the point where we want to get beyond, pure trading on options volatility. And he also has a bunch of earnings trades. The one he mentions is persistence of movement and after earnings, after a positive earnings event. And again, it's in his book. I won't get into it. Ron, have you gotten into any of this kind of area?
Yeah, I've done all of them. So, okay, a couple of notes. So for the first one there of essentially trading VIX futures or VIX ETPs, definitely doable, but you just can't you can't do it based on that one line, right? So if you're going to be shorting vol when you're in contango and then going long vol when you're in backwardation, that's not a trade plan, right? So you need much
No, it
more
isn't,
than that.
Ron,
And in
and
particular,
I absolutely do not intend any of these to be in any way a complete plan.
yeah, exactly.
Let me make that
I just want to
clear.
make sure everyone's clear on it.
No.
Yeah.
You could say that about every line in these slides, and it's fine if you do, but
Yeah.
His book
So, but in
has
particular, when you're
details.
short vol, yeah, right. So in particular, when you're short vol, you definitely need to know when the hell to get out, very, very specifically and quickly, right? When it starts going against you. And equally, you could say the same thing for backwardation. There's plenty of circle, reversion that can happen, even like yesterday, right? If you look at yesterday we actually went into into backwardation. And let me check right now, but I'm pretty sure we're back in container today. Next Central.
That's interesting.
Look.
At the
Sort of, yeah. So
yeah, I mean, all of these are extremely complicated subjects, and I'm just suggesting areas that people can look into. That's all. I mean, they have his book. It's not exactly an impossible task because his book is out there and it has extensive discussions of all of these areas. I wouldn't say extensive enough necessarily, but a start.
Yeah. For the second one, regards to factors, the stuff that's listed there really falls under the category of value stocks as opposed to the factor stuff. So value is one factor. And then he's giving you here a whole bunch of fundamentals that you can potentially track in order to isolate or choose your value stocks that you'll be investing in. But it's really one factor, which is value. He, in the presentation from today, he mentioned a few others. Surprisingly, actually, he didn't mention some of the most common ones, which are things like momentum primarily, or low volatility, as in historical volatility, not implied. But those are probably the easiest ones to trade, in terms of momentum and low vol. There's even some ETFs that you can trade that do it all for you. You don't have to go out and select them. They do all that selection based on that factor for you. And as a matter of fact, a whole pile of other factors. So if you do some digging on ETFs, there's probably 20 or 30 different factors that you can leverage with specific ETFs, so that they're trying to make it easier for you to invest in factors now through these ETFs. So that's something you can dig into if you want to. And the third one about earnings calls, and obviously if they've done well, then in theory that's kind of like a momentum play as well, to a degree, by then buying a call spread on the assumption that the positive momentum will continue for a while.
Yeah, I'm glad you clarified that. Okay, let me see what else I have here. Then he has a series of secondary trading strategies that he uses opportunistically, and they're some of them are buy straddles across earnings dates, more earnings trades. The selling overnight options, again, that has to do with when the options decay and when they don't on the 24-hour cycle. There are ways to exploit that. Obviously, I'm not even telling you what they are, but he outlined some of them in the book. And he also has some FOMC, Fed Open Market Committee, event trades. So it might give you some ideas. He calls, I thought it was interesting that he calls volatility positions, he calls butterflies and condors and calendar spreads volatility positions. I have some quotes coming up here, and I think we'll have some more and may generate some controversy. But he says these positions are primarily used to express views on volatility. I think that might be news to some people, or they might disagree. Would you? Ron? Would you agree that butterflies and condors are primarily volatility positions?
In very simplistic terms, sure. You could say that they're basically short vol, right? So if you put on a butterfly or a condor, and then you check your Greeks out, your Greeks will be fairly highly negative vega. So therefore you are taking a stance on volatility, right? So if volatility comes down, you make money. If volatility goes up, you lose money.
Anybody else? Yeah, thank you, Ron. Please don't let Ron and don't let me and Ron dominate the discussion too much. I'm just okay. Let me see here. I'm sending an email at the same time. And okay. Now for straddles and strangles, he has the formula that if you do not hedge, you just let the position run. And here we're only talking about the expectation, not the individual occurrence, not every time. And this is also harks right back to what Ron just mentioned. Your profit or loss on a position is going to be vega times the implied volatility minus the eventually realized volatility when you liquidate your positions. Would you agree with that, Ron?
Sure. Yeah. There's also a bunch of papers on, like, if you got SSRN and so on, that you can get all these really interesting, if you're into it, fancy formulas when it comes to at the money straddles for calculating a whole pile of stuff with basic numbers without getting too deep into math or anything like that.
But I think it's quite striking that we need to be focusing on the vol. I mean, many people out there, they look at trades as simply, you get into it, you trade it. They don't, I think some of them don't even, they say, we can trade in low vol, high vol, and whatever. And maybe they can, but we need to be focusing. Does this also mean that if you have a positive Vega position, that you should only be doing that? Let me put it the other way. If you have a negative Vega position, you should be expecting vol to increase.
The other way around, right? If you've got a negative Vega position, your hope is that volatility will decrease in order to make money.
Your negative Vega, yeah, that's correct.
Yeah.
Now he uses GBM.
So,
go ahead.
Yeah. I was just going to. That reminded me of a point that you asked before, and you were kind of talking about, efficient market theory, and does it make sense to buy a put when the market's crashing and all that kind of stuff. The thing, I guess, that came to mind when I heard that is, even though this is a very simplistic way to look at it, when people talk about efficient market theory and all that, it's really more or less just saying that things are fairly priced. Right. So Ewan was talking about an inefficiency in a market doesn't last long. And that's true, especially these days with, automated trading, high frequency trading, machine learning, all that kind of stuff. They can find inefficiencies in, microseconds and then try to take advantage of that. We can't compete with that. But then taking the jump to saying, since everything is efficiently priced, we can't make trades. Those two things don't kind of line up, right? So if you are in a position that you are paying a fair price for a put, which is what you were asking about, right? You're saying, if I think the market's crashing and I go and I buy a put, does that make sense if everything is already priced in? Well, yeah, it does, right? In the sense that if the market does continue to crash and vol continues to increase, then that position will make money. The fact that it was fairly priced is not a negative. It's actually a good thing that it's fairly priced, right?
Why should we suddenly need to hedge if what's different now that the market is crashing? Shouldn't we assume that it has already reached the appropriate price? I mean, this gets into almost philosophy, and it's impossible to come up with an answer. But if the market is efficiently priced, go ahead.
Yes. Well, one of the things, and I'm saying this as well from some algo communities that I participate in, but a lot of people always think that IV is always mean reverting. And that's what everybody says all the time. But when you jump to the algo trading side of things, and then you start running backtests and deeper analysis and so forth, you'll find that there's actually something called volatility clustering. Yeah, so what volatility clustering is the exact opposite. Okay, so that when you get a spike, it's not going to mean revert in this case. It's actually just going to cluster at a higher level, similar to what we saw after COVID, right? We didn't see that one spike and then we went back through to VIX of 13, right? We spiked, but then we went back and we held still at about mid-20s. That is these days even still considered normal. 22, 23 is considered normal. So the environment can change.
Phenomena.
And you can get volatility clustering.
Both phenomena happening.
Yeah. And so what can happen then is that if you have that initial spike, you've got a lot of the retail side of the crowd that are immediately then jumping on through to short vol trades. Do you see what I'm saying? So in other words, there's a spike of IV of whatever, even 5 points or something. VIX goes up by 5 points, and they go, ooh,
Yeah, that's right.
down day, vol spike, I'm selling it, right? Short vol trade. But then if you're moving into a scenario where the volatility is actually going into a cluster effect, now you do actually have a situation that is not going to be priced so-called correctly if it does cluster, right? Because everyone is now starting to enter trades for short vol to try to kind of push that thing back down, but it goes the other way. So if you're in a scenario like that and you are buying a hedge and vol does explode, then that volatility hedge that you've just purchased can really explode in price as well, right? So yeah, just having something be fairly priced doesn't mean that you shouldn't be buying it.
That was Mandelbrot's originally, right? Clustering. He discovered that phenomenon. It's a very prominent phenomenon, and you need to allow for both. But it's very, very difficult to. Well, I'm seeing some of these strategies seemingly work. I mean, I don't know if you look at something like AIC or Weirdor, in which they progressively add put protection or as the market goes down. And some of those strategies are, as far as I can see, the most successful there are, at least on paper as to the results. So I can see it works, but I'm just trying to reconcile whether it should or not.
Right. Yeah. But I think one of the big points that what Ewan was trying to portray here is don't fall into the trap of thinking that the structure is the key. The key is understanding the edge that you're trying to mine and then choosing the best vehicle to mine that edge. Right? So, especially for any kind of more beginner traders that were listening in today, Ewan mentioned at one point saying iron condors work. Please don't go away thinking that he's just told you what the magic trade is, because it's not. What he's implying is that the odds are that you'll win 9 out of 10 of those. That's what he meant by it works, right? But then the problem is that with the one time that you lose out of 10, it's not going to be, the size of that loss typically is nowhere near what a normal win is. You're winning in small size, but then you can then take one big hit that one time out of 10, and that one loss may wipe out all of your gains and sometimes even then some beyond that.
Right. And in fact, he has that point in his book, and I have it quoted here. And it's showing at the bottom of this slide, strangles or condors will make higher medium returns and a higher win percentage, but this can make it more difficult to distinguish between good trades with expected value and good luck. Confuse it with, we might say. So in other words, if you start selling a lot of condors, then you quickly draw wrong conclusions unless you're very, very careful, because your losses will be huge, as Ron just said, but they'll only be rare. And a lot of people who are in this business and traders generally, not only newbies, go around changing, their method on the basis of, a momentary change in the market, and on the basis of a few winners. You can't do that. It's wrong. Now we have here Josh Berg saying, why GBM not applicable to market options with dividends, period? Referring to a reference here now. GBM, who knows? Let me have a test quiz here. Who knows what GBM stands for? Not too many takers. Josh, do you know what he knows? Well, actually, I don't think so, Josh. GBM stands for geometric Brownian motion. Well, it may stand for some other things as well. And it turns out that is the same thing as what's called a Wiener process, which fits in with a normal distribution of returns. Doesn't take into account jumps. Yeah. Josh, did you have any comments you'd like to say on the mic? It sounds like you're pretty knowledgeable. Interested in hearing any comments you have at a little bit more length. Also, while we're, let me see, well, we're almost out of time. Anyway, those are a few ideas. He does actually cover calendar spreads in his book. Okay, let me get Josh in here for a second. I'll unmute his mic for him. Josh, if I can find him, Josh Berg. There you go, Josh. You got your mic is on now. You might have to get it working. Anyway, I'll just keep talking while you're doing that. Just interrupt me, please, if you get ready. So I've highlighted some points there. He has other chapters on directional options trading, trade sizing, meta risk. I think we had a little good discussion here. Josh, any luck? Well, not yet. Right, Josh will come back to you if we have time. Okay. Ryan is going to present. Go ahead. Let me unshare, or you just take it from me, Ryan, please. Let me just see.
Sounds good. Thanks, Don. Okay, can you all see my screen?
Yes, we can.
Okay, so you see the chart of the VIX here?
Yeah, I think I've just unmuted myself.
Okay, well, just hang on, Josh, and we'll come back to you in a minute. Good.
Sure thing.
Go ahead, Ryan.
Sure. So, yeah, we talked a little bit about the VIX, and everyone's familiar with the VIX and what it is. It's basically an average of all the options and kind of comes up with a number for the 30-day volatility. And then, of course, VIX Central, which Ron mentioned earlier, he said, is it kind of in contango? Is it in backwardation? And this essentially are the futures, right? So this is the spot VIX here. And then these are the futures on that. So essentially, if you're buying a VIX future, you're trying to make a bet that in the future, VIX is going to be higher than where it is today, where this future is today when you purchased it. And so this graph here is showing more risk in the short term. For instance, in February 16th, which is when this expires, right? So this is basically showing that on February 16th, which is 30-ish days from now, or I guess a little bit less than that. So basically, that's where they think the VIX is going to be then. That's a 30-day VIX. Now, I don't actually use VIX Central when I try to determine if something is in contango or in backwardation, because the futures are one step removed from the actual options themselves on the S&P 500. I use this website instead. So this is the term structure data of the actual implied volatilities put out by the CBOE. Okay, and so here we are seeing basically the volatility is the same VIX formula applied to the entire chain, but it's applied to each individual chain, right? So here's February, March, April, etc. And you can see that this is in contango, whereas these futures over here are kind of in backwardation, right? And that's because this is 30 days removed from this right here. Now, if you wanted to see what this data looks like in Thinkorswim, then of course, if you pull up Thinkorswim, you can see over here, this is kind of the implied volatility of the various months. So these numbers here actually correlate exactly with these numbers here. Okay, so that's what you're looking at. Is basically these numbers, but in a chart format on CBOE, which is a free website that anybody can use. Now, if you looked at the implied,
I think if you hit /VIX and you go to product details, you can actually see a yield curve.
yes, you can. You're absolutely right. Now, this down here is the implied volatility that is for 30 days. So that not to be confused with these implied volatilities over here. This is a 30 days, which is actually very similar to what the VIX is today, right now. But if you were to open up these various chains, then you see an additional implied volatility. So this is like at the money, essentially, for this individual strike. So most of you are familiar with all this. This is review for everyone, but I just wanted to clear that up. And then you were saying, John, if I say slash, you say
Yeah,
VX?
Josh, slash VX. So you bring up the
Yep.
future, and then if you hit product details, so you go to trade. Where's your product details?
Yeah, it's weird. I don't know.
Yeah, that is strange. On mine, I have a product details tab that either brings up my volatility smiles or gives me the option to bring up the contango curve so that you're able to view it.
Maybe I need to enable something or download an update. But in any case, I'll check that out later and try to figure that out. But I've seen that before. I know what you're talking about. So what I've done here is I really wanted to see. I want to get more. I really wanted to see this website, right? But I wanted to do more with it. I wanted to enhance it. So what I've done is you can actually go to TD Ameritrade, developers at tdameritrade.com, and you can sign up for an account. It's a free account. And if you go ahead and log in and then you go to APIs, you can come down here to option chain, right? And you can say get option chain. And this will allow you to download the option chain in JSON format. So here I've already filled it out. You basically say SPX put options, strike 37.75, and I put in the March contract, and you hit send to get the data, and this will spit out all the data in Thinkorswim. So we're not using RTD or real-time data. TOS doesn't have to be open. This is just straight from the Thinkorswim servers, and you get all this great information. Okay. So then you can actually, if you're, I'm using Visual Studio here, and I have ASP.NET and .NET Core. So if anyone's a software engineer, you know what I'm talking about. This is the Blazor format. So I created this website essentially that will show some of this stuff. So here is basically what I did is I rounded the S&P to the nearest 25-point strike. So here is 37.75, and also downloaded the VIX from the Thinkorswim APIs. And then these are the at the money strikes volatilities. Now there's no way to actually get these volatilities over here. You could download the entire chain and do the calculation yourself, which I'm considering doing. But for right now, I just kind of grabbed these numbers here.
What do they do for those chains? Those numbers are just delta weighted, or what do they do? Like some kind of weighted average?
It is a weighted average. It's literally the VIX formula. Yeah, you can look up.
No, delta. I think it's delta weighted for their. They use the VIX formula to get their individual contract tenor IVs. Really?
I don't know what Thinkorswim uses over here. I just know that if you go to the CBOE website, you can read about how if you read down here about their methodology and their white paper.
Oh yeah, I was talking about the TOS volatilities. I think they use a delta weighted average for those. It's not.
In a lot of cases, they never fully disclose. Like if you look at their so-called implied move or market maker move or whatever they call it.
Yeah, it's really fuzzy. I mean, just bring up like that 29 and take a look at ATM. It's definitely not 29.
Right, exactly. Yeah, it's not at all. Yeah, 28, 22. Yep.
Right? Like it's not even close.
No, it's not. So yeah, they're basically looking at all of these across the entire chain, and they're averaging them somehow.
Yep.
And I
Yep.
believe the way that they're doing that is outlined in the VIX white paper, because these numbers here like match up exactly with what you see right here.
Oh, no way. Okay, I always thought it was a delta weighted average that they were
Yeah,
taking. So it looks like they're using some VIX methodology. So probably just weighting puts and calls in some way.
exactly. Yep.
Yeah.
All right, so going back to this. So what I've done is I trade calendars. So here is the various expirations, and this is the at the money implied volatility. The number in parentheses is the days to expiration. So these line up here with these numbers right here. And then I have basically the price of the calendar, and then how many days are actually in the calendar. So, from February 19th to March 19th, there's exactly 28 days. And but then you can see from like these dates down here, it actually will change, right? So this one has 28 days, this one has 35 days. So that's why this calendar is more expensive than this calendar. Does that make sense? Because there's actually literally more days between the contracts, even though it's shorter DTE, or it's closer in time. There's more days in it, and that's why it's more expensive. So you can kind of get a feel for what the average cost would be for a 28-day cycle, for instance. And then what's a lot of fun is you can click on this, and it takes you to a analyze graph. And let me actually go to this one instead. So this is showing the implied volatilities again, and it just shows you the cost of the calendar. And here is a you can zoom in and zoom out, etc. right here. But then what I'm showing is I'm calculating that in 30 days, right? Because I put one of these on every 30 days. This will return about a 18% profit. Now, obviously, a lot can happen in 30 days, and contango and backwardation, and it doesn't account for what happens as it goes down the skew curve. But it's literally the same thing as if you were to put this into thinkorswim and then increase the days going forward. So this guy here, I've actually put in the special dates, so you can see. Let's see, where was it? Yeah, so the expiration dates are actually highlighted in orange. But then and you can of course adjust this forward if you'd like, and see how many days you'd have to be in to get a 40% return on your investment on average.
A lot of them, probably like a couple of days before expiration with calendars.
Right. Yeah. And then of course we got delta up here. It's kind of fun. I calculate all the Greeks, etc. So this is just something I'm playing with for fun, and it's kind of helping me every day in my trading. And then this is kind of neat too. You can copy the trade, and then come in here to thinkorswim and go to the analyze tab and just paste it in, and then you can just analyze this guy.
Wow.
So it's really nice. It saves me a lot of time from having to go over here and open up this chain and click and shift click, control click, whatever. I can just copy and paste.
That's really cool.
You're not offering this website, are you, Ryan?
No, this is just running on my local host.
Right.
I mean, maybe one day when I eventually get the ability, because you can do all sorts of stuff in here. You can hook it up to, let's see, you can hook it up to various accounts, and you can pull in actual orders that were placed. And so you could literally run you could see the entire trade. So you could set up a complex trade, a campaign, for instance, and you could show it here in this graph just by using the API, which would be really cool. And then of course, if I were to harvest this data every day or tie into historical data, then you could do back testing as well. That's kind of where I'm going with it.
Does it take in real-time data, or is it just discrete updates, or how does that pull in data?
It is as close to real time. It literally is the same as what I see. I'll have this website, and so in this price for the calendar will update. So this updates every 5 minutes, this page will, or every time I hit refresh. And then, but it'll be exactly what's in Thinkorswim.
Wow.
So yeah, it's real time.
If you
Nice
have,
work.
if you develop a methodology for trading calendar spreads, or if you can articulate it to any extent at all, please let me know and we'll have a, give a talk.
Yeah, sure, absolutely. And what's nice, I can sit here and just like, I can just watch it go into contango or backwardation here, just watching this curve. It's kind of like watching the CBOE or VIX Central, but it's, this is a little bit closer to what I'm actually trading, since I'm trading at the money calendars. And then of course I got I put it into a phone app, for my phone here as well. So I have it with me everywhere I go.
What technology are you programming in?
This is all Visual Studio.
Yeah, but what?
Oh, C#.
Okay.
Yep. And then I could go through a trade if there's time. Otherwise, it's fine. We can just wrap up.
I mean, what type of graphics framework are you using?
This is all just stuff that's kind of built into Bootstrap and Blazor. And then this particular chart is called this Radzin is the name of that chart control.
Oh, I see.
Looks really good.
So can you run that on the desk? Well, I guess it's web based, so you can do that.
Yeah, you can publish it anywhere. Yeah, absolutely. It's just local host right now.
And I also have a bunch of apps, but they're totally unrelated to that. They're a different thing altogether. Very good, Ryan.
Yeah. So what I've noticed is that usually around 60 DTE is a good time to get into these trades, 60, 65, something like that. And then you're out pretty quickly, sometimes as early as 45 or 40 DTE.
Conrad says he was curious what a trade would be.
So here I have one. So this one I got into on January 7th. Started off with about $10,000 in margin here. And then, there we go. And then let's see, the market kind of did nothing for a while. So I'm just going to jump forward here to the next time I put on a trade. And this is January 14th. And you can see that, the initial trade was put on right here. This is that green dot. And then here's today. So the market just went sideways. So I was waiting for it to move before I put on the next tranche, and I did not move. So I just went ahead and put it on. So now we got 8 calendars on. And then the market ended up going up quite a bit. And so here's the chart now. So it kind of dipped a little bit, and then it went up on this big up day. I went ahead and just bought 4 more, and I'm doing these in the calls. Sometimes I do them in the calls, sometimes I do them in the puts. It doesn't really seem to make a difference. Usually, if the market is below, I will do it in the calls. And if it's above where I want to put on the strike, I'll do it in the puts. But
that's good to hear, because some people were saying that put call parity was violated in these prices.
Yeah.
Did you move that to? Did you add? Is that an add, or is it a? Did you make it a double? Did you make it like a straddle swap, or what's going on there?
Oh, I just added another calendar above the market.
Okay.
So the market moved up to 3850. So I put my original on at 3800.
Oh yeah, I see. I see on the right.
Market
Okay.
went up to 3850, and then I put the next one on at 3900. So I just straddled the market.
Yeah.
And I usually stick to the 25 point strikes because they just have a little bit more volume, and I also just stick to the monthly contracts rather than the weeklies because you just get a little bit better pricing. But anyways, then we all know that the market came back down, and when that happened the other day, I went ahead and just got out of the one I just put on a day or 2 prior, mainly to reduce risk to the upside or to the downside in case we just tanked. And I actually made a small profit on that when I took it off. And then my profit target is 20%, and I hit that today. So I got out of the trade, and this is what it looked like right before I got out of the trade. I know this says 18%, but if this is using closing pricing, because we haven't actually rolled over to the next day, but I got out for about 20%. So
Excellent. I think you should give your own talk, Ryan, when you're ready, and go a little bit slower so that people who, introduce what a calendar spread is and so forth for beginners as well. But this is excellent to understand what's been possible and impressive.
yeah, so I got into this particular calendar at about 70 DTE, and I was in it for 21 days and made 20%. So that seems to be pretty typical. Around 30 days in trade, and you'll make around roughly 20%. That's what I found.
What was the hypothesis on this trade? Was it a low vol environment? You were looking for prices to move up and vol to move up, or what was your idea when you got in?
Basically, it's this right here. So typically, it's contango when I get in. I get in just about every month, but usually, if the markets are acting normal, if the markets are not acting normal, I'll probably just wait, right? But if the markets are acting normal, I'll go ahead and get in, and then you can see here that if and right now these IVs aren't true because TOS doesn't actually have accurate IVs after hours, because the after hours trading kind of messes with them a little bit. So if you were to take like a snapshot at like 3:30, for instance, or 4 o'clock, these IVs would be better. And during real-time hours, they are better and more accurate.
Yeah, they don't align. The options close at a different time than the
That's right.
underlying.
Yeah, they're open for 15 more minutes. But in any case, like I said, if you get in around 60, 65 DTE in 30 days, you can expect to see about 20% profit, and that's just where we are right now with volatility today. If you go back a few years when volatility was much lower, you would not make as much profit. So it's a good time to trade calendars. And the hypothesis is just what you see. It's the pricing, basically you're buying this one and you're selling this one, right? Or you're buying this one and selling this one, and then 30 days go by and all of a sudden it looks like this, right? So the one that you bought,
that's one vol point though.
Like
you're selling it for one vol point contango. I mean, you're looking for vol to perk up in this trade, no?
Well, you want, if volatility does, we've done several talks on calendars here, and Mark, if he's on the line, he can probably explain it much better than me. But when volatility does, you actually don't need volatility to spike. In fact, you don't want it to go into backwardation.
I get that it's weighted, but for differential, we're talking about one vol point here, yeah?
Yes.
Okay.
Yep. Yeah, so the idea is the one that you sold is going to decrease in value faster than the one that you bought. That's the premise.
Yeah, that makes sense.
Thanks, Ryan. Josh, did you have some comments other than this?
Not on this, other than what I saw in terms of the program, it looks really incredible. I'd love to hear some more insights from someone who trades calendars.
Yeah, but let's not dwell on calendars solely. I mean, what did you think of the whole?
Well, we were just talking about calendars. I thought that's what you were referring to. If you're asking about Ewan's talk, I thought it was really great that you were able to find an author of that caliber to come join this talk. I really enjoyed everything that he said. It was great. I would have liked to hear him speak a little bit more about, from a professional standpoint, how he's tackling the volatility curve, and how he attacks the smile with a little bit more specifics, and also just in terms of what his viewpoint is and his point is on smiles. Like a lot of the volatility curves that we're looking at through some of these platforms isn't really representative of what what volatility is. It's not really designed for what we're viewing in a lot of respects. And it also would have been interesting to hear a little bit more about some of the dynamics as to when he sees how the smiles are going to evolve over the next little while, or based on what they've been doing for the past little while. Uh, for example, with equity curves with a notable call skew, how he's reacting to that and how he's tailoring, for example, risk reversals in order to take advantage of that.
Yeah,
I
that's
think it was
right.
Ron that posted a chart of a risk reversal. If you take a look at that chart, you can see there's two triangles, one big, one small. That's edge. As that bends, you can imagine that's what gives you your edge, provided that you have it the right way around, and your timing is good. But I would have loved to hear from the horse's mouth exactly how he would like to time that, how he what type of a blowout and what type of a bend in that smile he's looking for in particular in order to work that edge.
How do you trade in that area?
Yeah, I trade risk reversals quite
Or
often.
you do trade risk reversals? Oh.
Yeah, I do. I trade risk reversals quite often. In terms of commodities, I mean, typically you look for those things to blow out. It's mainly an FX trade. If you take a look at any textbooks or you talk to anyone who's ever traded FX, the risk reversal is the main thing that they're looking at. If you look at the Bloomberg terminal, it's quoted in you have your risk reversal, your butterfly, uh, according to your 25 delta, etc., all quoted. Those are the quote specifications. So every trader is looking at those types of things in a balanced skew environment. With commodities with a forward skew, it's a little bit different, and then with equities with a back skew, it's different. And of course, nowadays with a call skew and equities, things are completely unbalanced. So it's
Yeah, we need to get into a lot of those areas, and we will. If you wanted, can you join our group or send me an email? I'd like to stay in touch.
Yeah, for sure. I've joined your group, and I sent you an email a little while ago. And I've attended a couple of these talks, and I really like what you guys are doing. I think it's quite incredible.
Great, thank you very much for those comments, and I'll check for that earlier email. I'm sorry if I overlooked it. And anybody else have any? We have to go. People's we're at well past our time. Anybody else have any comments or final other points to raise?
Can I leave you with a final thought? Is that all right?
Go ahead.
You're probably not going to like it, but I'll say it anyway. And put it this way. Actually, let me put it as in terms of a question. So what was the main edge that Ewan is claiming with that trade that he showed, which was a hedged risk reversal? How did he describe the edge that he's mining?
Oh, is that a question for me?
For anyone that wants to answer.
I don't, let's not spend a lot of.
I think, well, Ron, I could tell you that from experience trading those, and I think that, I mean, you're the one that posted a diagram. You could probably see from the diagram as well. If the skew bends back, it provides you with a small lift, and that lift provides you with padding for theta decay, such that you're able to take advantage of the directional trade.
Okay, we can't get into a long discussion. And Ron, is that the general ballpark? You're looking
not
for?
Exactly. All right. So let me put it this way. So and I'll try and be brief. The way I'm just referring to the way that Ewan described it, not your opinion, Josh, but
sure.
The way that Ewan described it was that puts out of the money are priced higher than calls that are out of the money. And he actually described that as an edge, which actually surprised me. Because in my opinion, that's actually not an edge. It's just a way things are.
I totally agree with you. And
right?
that's exactly what was going through my mind.
Right. Because that's always the case, basically, right? You go to SPX, out of the money puts are always going to have a higher IV than out of the money calls. Always.
Okay.
So
that's good.
Okay.
Yeah.
Fine. Thank you. Anybody else have any final points? If not, we'll thank everyone for joining us and for what I thought was a very rich discussion. Thanks to Ron, thanks to Ryan as well. And we'll end it there. Thank you. Good night.